Hi everyone, welcome back to Wise Wealth. I'm Kazu, and I'm here to help you live a life that's not tied down by money. Whether you're staying in a job just because it pays well or giving up on your dreams because of financial limitations. Through this channel, we're learning how to achieve financial freedom by understanding accounting principles and making smart financial decisions. In our last video, we talked about how to build a diversified portfolio that balances risk and reward. Today, we're going to dive deeper into the next crucial step: assessing your risk tolerance and how to create a personalized investment strategy based on your financial goals and comfort level. What is risk tolerance? Risk tolerance refers to how comfortable you are with the ups and downs of the market and the potential of losing money on your investments. Every investment carries some level of risk, and your ability to handle that risk will determine how you structure your portfolio. Understanding your risk tolerance is essential because it helps you create a strategy that aligns with your comfort level and financial goals. Investing beyond your risk tolerance could lead to panic during market downturns, causing you to sell at the worst times. Factors that influence risk tolerance. Several factors can impact your risk tolerance. Age. Generally, younger investors can afford to take more risks because they have more time to recover from any market losses. As you get older and approach retirement, you may want to shift toward more conservative investments that focus on preserving your wealth. Financial goals. Your goals play a huge role in determining how much risk you can take on. If you're saving for a short-term goal, like buying a house in the next few years, you may want to invest more conservatively. However, if your goal is long-term, such as retirement, you can afford to take on more risk since you have a longer time horizon. Investment knowledge. The more you know about investing, the better equipped you are to handle risk. If you're new to investing, you might feel more comfortable starting with lower risk assets. As your knowledge and confidence grow, you can gradually take on more risk. Emotional comfort. How do you feel when the market drops? Some investors can handle volatility without getting too emotional, while others may panic at the first sign of losses. Knowing how you respond emotionally to risk is just as important as your financial ability to take on risk. Portfolio ratios for young and older investors. Now that we understand risk tolerance, let's look at some example portfolio ratios that align with different stages of life. For young investors who are focused on long-term growth, I recommend a more aggressive portfolio with a heavier focus on stocks. 1. 70% in stocks for long-term growth potential. 2. 10% in bonds for stability. 3. 20% in cash or liquid assets for emergencies or new opportunities. This portfolio allows younger investors to take advantage of the higher growth potential of stocks while keeping a small portion in bonds and cash for stability and flexibility. For older investors nearing retirement, a more conservative portfolio may be a better fit. 1. 40% in stocks for moderate growth. 2. 50% in bonds for stability and income. 3. 10% in cash or liquid assets for security. This portfolio is designed to reduce exposure to market volatility while ensuring there's still some potential for growth and liquidity. Balancing risk and reward. The key to building a diversified portfolio is understanding your risk tolerance. How comfortable are you with fluctuations in your investments? If you're younger, you may be able to take on more risk because you have time to recover from any losses. If you're nearing retirement, you may want to focus more on preserving capital and reducing exposure to volatile investments like stocks. A good rule of thumb is to allocate your investments based on your financial goals and where you are in your life. For example, younger investors may have a portfolio that is more heavily weighted towards stocks, while older investors may prefer a higher percentage of bonds and other stable income-generating assets. Your next steps. Take some time to assess your own risk tolerance and think about your financial goals. Are you more comfortable with aggressive, balanced, or conservative investing? Once you have a clear understanding, you can create an investment strategy that works for you. Let's continue building our financial knowledge and working towards wise wealth together.